Hey everyone, welcome back to the channel. Today we're going to talk about the recent ARK model put out about Tesla. We're going to kind of dive into the model. I attempted to recreate it. It's not quite perfect, but based off what they gave us, kind of the best guess we can do here. So if you're not familiar, back March 19th, 2021, so just 6, 7 days ago, ARK published a new price target for Tesla in 2025, and this thing is absurd, right? They estimated it would hit 7,000 per share. Um, so 1,400 after the 5-for-1 stock split, and then now they're saying it could approach 3,000. Um, their bear case is 1,500. Their bull case is 4,000. And then they give us a handful of the kind of inputs here. So cars sold, 5 million in the bear case, 10 million in the bull, with the average selling price. And then that will translate to a revenue number. From there, they have some ancillary business with insurance. And then in the bear case, right, there's not going to be fully autonomous vehicles yet. So Tesla's going to still, they're going to take on Uber and Lyft because that's, the most strategic priority for them. And that's going to generate 42 billion. And then in the bull case, there's going to be autonomous ride hail services, which is going to be 327 billion. So almost as much as their electric vehicle revenue. And we'll touch on this in a little bit, but I think these people are smoking crack over here or something. This is pretty absurd. Uh, Electric vehicle gross margin, right? Currently 21%. They're expecting. In the bear case, they're going to have great margins. In the bull case, they're going to have bad margins. I don't know what the difference is there, right? Is it just to get to the price target you want? But why aren't production and everything going to be the same? And if you're producing more vehicles actually to have this huge autonomous fleet and you're selling twice as many cars, wouldn't your margins be better because you'd have economies of scale? It seems almost flipped. And then if we look, total gross margins, 43%, 50%, this one actually kind of makes sense. They're like, hey, if we have this autonomous fleet, it's going to be basically 100% margin. Um, and then total EBITDA margins, right? So I went ahead and tried to back into this, these assumptions. So like right here, right, 367, this ties to their assumption at 10 million cars sold, 367 billion. And then I have it lumped in here as other revenue just from my old model of 330. And this is going to be composed of the autonomous plus the 6 billion of insurance revenue. So some interesting things to note to get to these numbers from where they currently are. Automotive revenue has to grow at 68% a year. Oh, okay. On a base that's only getting larger. I don't know. Let's pull this up and just take a look, right? So this is, we did a comparable analysis the other day, right? So if they're producing, in the bear case, 5 million cars, that would make them the third largest auto manufacturer in the world in just 5 years. Hmm, crazy. And if they hit the 10 million, they would be the largest auto manufacturer. Obviously, yeah, these companies are all going to produce more cars, sure. I don't disagree with that, but you're basically saying they're going to go from 1/5 the size of, GM to being the largest auto manufacturer in the world, basically. Um, Definitely a bull case, that's for sure. And then their other sales growth, right? I mean, basically, if you're really behind the whole, they're gonna produce this autonomous vehicle thing, right? Sure, maybe overnight that seriously just spikes incredibly large. Problem with that is, right, we're saying 327 billion of autonomous driving revenue. Um, I was interested. I was like, what's Uber's current sales? What's Lyft's current sales? How big is the ride hail market? Ah, okay. So Uber's doing 11 billion. COVID, right? Let's go back to 2019. They're doing 13 billion. Okay. They did 10 billion before, growing 30%. Not bad. Lyft, same size? No. No, 3 billion in 2019, 2 billion in 2018. And a lot of this is Uber Eats and things of that nature as well. So we're saying we'll go with 2019 numbers. 13 plus 3.6 is 16, we'll call it 17 billion. So the $17 billion ride hail market is going to transition in 5 years into a $327 billion ride hail market. And this is assuming that Lyft, Uber, Google are not participating. In case we forgot, right? Like Google's developing Waymo, which is self-driving cars. I'm sure they would enter this market as well. Lyft and Uber aren't just going to go away. So in reality, we're saying this is, a $500 billion industry in 5 years, growing from 17 billion. I don't know. I don't know. The 42 seems a little bit more reasonable. I mean, you're still projecting like exponential growth in just ride-hail services, which I think is still a bit crazy. So, anyways, enough on that. And then to hold kind of the margins, because they give us a margin profile, right? EBITDA margins of 30%, gross margins of 39%. Um, so in this scenario, we can't even get to so they actually have gross margins of 50%. We can't even get to that in 2021 if we straight line all the projections. So in reality, they're probably expecting higher revenue growth early on and then have it dip down. But you basically your other revenue businesses operating at a 10 to 20% margin kind of in the later years. And then SG&A, this was actually kind of reasonable to get back to the EBITDA margin they had projected. Obviously, they're going to have different CapEx assumptions than me just based off how they have their revenue modeled out, but I didn't see a kind of a year by year statement. But to say that this is like even feasible, like even if they can make all this happen, then we come look over here. I mean, you have to assign a low average cost of capital when in reality, this is like the most risky and absurd growth trajectory I think I've ever heard for a company. Um, and then on top of that, you need just some crazy terminal value just to get a $4 trillion market cap in 5 years. Um, from a fundamental perspective to hit that, right? Like, don't get me wrong, they could trade at $4 trillion because people are just crazy, but from a pure fundamental standpoint, there's no way this is happening. And, we'll flip over to the bear case. I thought, maybe this will be a little bit more realistic, right? And, for the revenue, automotive sales growth, 54% to hit that final 234 billion that they project. I would say that this should be a bull case, not the bear case. That seems aggressive, but, doable. And then on the other sales piece, right, the autonomous driving, I guess in here there's no autonomous driving, it's human driven. But if they actually do launch into that and their other businesses continue to grow, sure. 72% is aggressive, but maybe they can actually make it into a semi-material business. I could kind of get behind this. I was like, okay, this could be if everything goes perfect, I think their bull case might be a bear case from this scenario. But then we get into the margin profile. That's where I think it kind of falls apart. So in this case, they say you're going to have 40% margins on sales of vehicles. And then I actually think they like directly contradict that in one of their assumptions. Using Wright's law, gross margins never exceed. So I mean, I don't know. Here it's 40%. Here it's 25%. So yeah, I don't know. Seems interesting that the margins are so much better in this case. But so we're going to have their margins just improve like crazy. On top of that, their other stuff is going to have super great margins when in reality, once again, um, what do you think the margins are on ride hailing for Uber? Loss from operations. I mean, they're not that good. They're not even operating profitably. But we're gonna come here with Tesla, and we're just gonna have great margins. And obviously, I mean, cost of revenue. So I guess right here, right, it actually is about a 50% margin. Um, and we're saying we're going to be operating at 60% and then slowly go towards 55%. So we're already going to just come out of the gate operating more efficiently than Uber or Lyft, who've been doing this for years. And then SG&A, once again, this is kind of probably correct as the company grows. But another problem with this is, right, we have a weighted average cost of capital, 7%. So very low. So I mean, like if I were to take this bear case, right, call it my bull case, everything goes perfect. 5 million cars, they're one of the largest auto manufacturers. They have all their plants up and running, everything's flawless. There's still the demand 5 years later to buy the same 5 different vehicles. But let's use like a realistic cost of capital that I'd want as an investor of 10% and an actual terminal growth rate of 3%. Um, you get 590 billion, which is, I mean, where's Tesla trading today? That's probably closer to where they're trading, to be honest. So it's, I don't know. I think this ARK price target is just a little bit absurd, if you ask me. And I'd love to hear your thoughts and opinions below if you have any. If you think, okay, so 600 billion. Um, yeah, I mean, I think in their bear model, if you have reasonable expectations on your return and a reasonable terminal growth, maybe you could make the argument that Tesla is fairly valued today, which I think in just about most people's mind is probably a stretch, unless if you're a Tesla fanboy, which there are a lot of. But I saw this model come out in the price target, and I was like, this is just some stupid PR stunt. And they're like, oh, we did a Monte Carlo simulation with 32 factors and yada yada, and it's like, or 34 factors, and that's great, but I mean, come on, to say that Tesla is going to become a $4 trillion company and be fairly valued at 4 trillion is just absurd. Um, Unless if we have like hyperinflation, right? And the average selling price is really 360,000 a car or something, due to inflation. I don't know. I think it's a bit of a stretch. Love to hear your opinions and thoughts below if you disagree or agree. But yeah, I thought I'd just pull this together because I, came across this and I thought it was a bit funny to try to back into their numbers. And their EBITDA numbers I think are a little bit different than mine. Um, so clearly in their model they're making some different assumptions. They're not kind of straight lining this, obviously, but in their capital, I think their capital assumptions are a little bit different. But in reality, like I think mine are probably more conservative because it's the historical capex, and in reality, to hit these capex or to hit these numbers, you're going to have to invest way heavier in capex. So it's just going to lower your free cash flow. So I don't know. It was a fun little experiment to kind of throw together, but let me know what you think, and yeah, I look forward to it. Thanks.